Good afternoon, everybody, and welcome back to our Closing Bell webinar series. For those of you that do not know me, my name is Josh Levitan, one of our day trading instructors here with Cyber Trading University. Let me just get a quick sound check first so I know everybody can hear us loud and clear. All right, perfect. Good to see you guys back here again. Leda, Morris, Michaela, Ed, Pete, everyone else rolling on in right now. Ron, good to see from hear from you again, Ron. All right, guys. Well, listen, we had a quick rescheduling from last week. We had a couple audio issues with us today, and I know not only just with Cyber Trading University, but everyone else that follows us. We have a ton of options traders in our room. And who better to deliver a presentation regarding options than the man himself, Larry McMillan. So, Larry, what he was intending on going over last week is what he'll be going over with you this week, and that is, just like the title says, the current status of options-oriented indicators. So, Larry will be sharing with you, with his over 35 years of experience, everything between his experience, between what he has in his book, his best-selling book, by the way, which you guys can get from his website, Options of a Strategic Investment. Larry will be essentially going over with you the current status of these options-oriented indicators, understanding price action, understanding volatility indices such as the VIX, and how to correlate Larry's methods to those markets. Now, Larry, are you there?
Yeah, I'm here, Josh. Ready to go.
Awesome. The floor is all yours, Larry.
All right, thanks. Good afternoon, everyone. This week we're not going to get too fancy with the indicators. I'm just going to use this laser pointer most of the time. Um, our company, McMillan Analysis Corporation, has essentially three aspects to it. The first is our research, which appears mostly in the form of our recommendations and newsletters. Also manage money. We manage money for about 90 option-oriented accounts right now. And then we do a certain amount of option education, seminars like this, mentoring, etc. If you want to get a copy of the slides today, you can find them at this website, optionstrategist.com/CTU, as well as some discounts on some of our newsletters and other products. So when I'm looking at the market, I don't just look at option indicators. I look at these four broad areas. The first being the chart of the S&P 500 itself, because really price is the most important factor when talking about the market. If your indicators are saying one thing, but the market's going the other way, then the market wins. But then one of the more important option-oriented indicators that we do look at is put-call ratios. We'll be talking about those, market breadth, advances and declines, and then also the volatility indices, the things involving VIX and other various derivatives regarding volatility. Before we start, I just want to say one thing. A lot of the time in the last couple of years, especially up until, let's say, last August, the market was overbought for long periods of time, but it still kept going higher. So overbought does not mean sell. It just means, you could be prepared to sell or something like that, but it's definitely, when we say something is overbought, it's not a sell signal. And conversely, if we say something is oversold, that doesn't mean buy either. Markets can drop a long ways when they're oversold. So just to say that an indicator is overbought or oversold is not a signal that you would want to act on. Here's the current chart of SPX, a 2-year chart, and a couple of things are evident here. Obviously, first of all, this resistance area up here. There's one downtrend line left that hasn't been broken yet, or maybe this one connecting now the April high at 2110. But by and large, we keep coming back into this 2100 area and failing and dropping back. We've dropped back all the way to 1810 four times in the last 2 years, and that's provided tremendous support. I you could consider, I guess, as a huge trading range. I mean, I don't really know that we're going to go back to 1810 anytime soon. But the one that, more practical near-term support level would be this 2040 area right in here. If that were broken, then there could be problems. But in the long run, the market is not really trending and hasn't been trending for a couple of years. It has these short-term trends, but not a long-term one. Here's a 1-year chart of SPX. It has a few more of the things that we look at. We'll be discussing these individually. First of all, you can see here that most recently we had a series of lower highs, so that gave us this downtrend line right here. And then we had support bouncing off of 2040. We probed through 2040 a couple of times, but we never closed below there, so that was support. Last week, we broke out of this triangle on the upside. So when you break out of a triangle like that by classic technical analysis, that's pretty powerful upside move. We'll see if it can continue. We also two formations on this chart, these blue W's here, and those are usually very good buy indications. We had one last fall, and then we had one again this earlier this year. So those have run their course, of course, but those are the kind of things that we look for: retests of lows that hold, and just classic technical analysis. But this chart right now is on the short term telling us that SPY or SPX is moving higher, but we're about to run into some resistance up here, as we saw from, well, both this chart and the last one. So we know there's support at 2040. We'll probably see resistance all the way up to the highs at 2135. If we can break through there, then that might cause some short covering. But I would think until you got there, the shorts are going to continue to try to sell this market, hoping that it retreats off the highs of this old range once again. The triangle breakout that we just saw was positive, of course. And so overall, it's kind of a neutral chart because we are in this trading range, whether you consider it to be that big one that I showed you before or the smaller one between 2040 and 2135. Until we really can break out of that range, there's tradable moves, of course, but nothing trending. Now, that last chart had some buys and sells on it. I want to discuss those just a little bit further. Um, Bollinger Bands, I'm sure you're probably familiar with those. And when John Bollinger invented Bollinger Bands originally, he defined the volatility of the stock market as the standard deviation of the closing prices over the last 20 days. And that seems like a reasonable definition of volatility, but in reality, according to the math professors, it's not. Uh, and since we're an option-oriented firm and we do a lot of work with the Black-Scholes model, the Black-Scholes model uses a slightly different form of volatility, and it's the standard deviation of daily price changes over the last 20 days. It might not sound like a big difference, but it does mathematically create something of a difference. So in our work, when we're dealing with volatility, by necessity, we need to use the Black-Scholes definition. Otherwise, our option implied volatilities and other things like that wouldn't come out right. And so I took that definition of volatility and applied it to the Bollinger Band. Otherwise, the Bollinger Band calculations, where you draw two bands around the 20-day moving average. And that's what these wiggly lines are here. So these are the upper Bollinger Bands here, lower Bollinger Bands here. And then we built a system around it. If we close outside the lower Bollinger Band, say as we did here last August, and then close back inside the next lower, so these are the -3 and -4 standard deviation Bollinger Bands, that's a buy signal. So we had a buy signal there, didn't get off to a great start, but eventually had a good move. Same thing this past February, we closed outside the -4 standard deviation band and closed inside, so we had a buy signal there. Again, a bit of a rocky start, but then a great move. Last fall, we were fortunate enough to get a sell signal right near the top at that time about 2120 or even 2115 or so on S&P. We had a false sell signal before that, so we had the false sell signal marked in blue, and then the actual sell signal marked in red. So far, we haven't been able to accomplish a similar thing, and the market doesn't have to give a Bollinger Band signal before it decides to go somewhere. I'm just saying it'd be nice if it did. So perhaps we will rally up here towards the all-time highs. You can see here that the +4 standard deviation band right now is up there at about 2125. And so it would take a little work to get up to that level, but that's not that far away, of course. So right now we don't have a signal from those, but it's something that we watch for. And if you read our commentary, you'll see that we mention this fairly often. Now, there's one other kind of broader perspective. We've been talking about this really for about 6 months now, even more, even longer than that. But the end of 2007 and the beginning of 2008, there are a lot of similarity to the end of last year and the beginning of this year. And whether that will continue or not, I don't know. But as long as the similarity is still there, I think it's worth discussing. So I have 9 points marked on this chart, and they're also summarized on the next slide. So when you download the presentation, you'll have the list of them. So you don't have to madly write these down. You can just listen if you prefer. So the first thing we had in both cases was a bad break in the market. It came in July of 2007. That's, everything had been going pretty well up until then for a number of years, really since the 2002 bottom up to July of 2007. The market broke when we first heard of something called the subprime debt crisis. At the time, it seemed scary, but then the market recovered and rallied back late in the year. So this year, or last year, we had the bad break in August, but then it recovered, as we saw from the W formation on the previous slide, and recovered into the end of the year, into the fall anyway. So um, in 2007, the market made new all-time highs. Last year didn't quite get to new all-time highs, but it was a strong rally. Then we started to have a series of declining tops. So number 3 here shows is the series of declining tops, and we had those again last year. But there was a very strong rally into Christmas, and we had that last year and in 2007. And then a very telling sign: the Santa Claus rally failed. Now the Santa Claus rally is a seasonal trade invented by Yale Hirsch, or identified by Yale Hirsch, the Hirsch organization. And it basically looks at just a 7-day trading period, the last 5 trading days of one year, and the first 2 trading days in the next year. Most of the time, the market goes up over that 7-day period. So if it goes up, that's fine, everything's normal. But if the market goes down over that 7-day period, that's a pretty bad warning sign. And we did an article earlier this year detailing like the last 5 of these, and they've all been pretty much led into disastrous markets. Well, in 2007, you can see that that period of time failed, and from there we had a severe drop of almost 200 S&P points into Martin Luther King holiday. Well, that's almost exactly what happened this year. We failed on the Santa Claus rally, and then we had a severe drop in early January all the way into the Martin Luther King holiday, from which point we rallied. Now, in 2008, it took 2 months to come back and retest the lows. This year, it took just 1 month to come back and retest the lows, but those tests were successful in both cases. 2008, a 2-month rally ensued. This year, a 2-month rally ensued. That rally peaked out in 2008 there in May, and by July, it had already broken through the January lows. Now, I'm not saying that we're necessarily going to break through the January lows from here, but it is a possibility. You can see that things can turn on a dime, as they did then, and they certainly could do that again here. As we get through more of this presentation, you'll see that I have some doubts about, whether the market really would drop that far that fast at this particular time, but it's certainly been a possibility. And I don't think you can just, routinely say that the lows are in for this year. So here's the list of those items, the same ones we just talked about there. So when you download the PowerPoint, you'll have that list of the things I was just discussing. All right, so much for just reading an SPX chart. Let's throw in a little bit of option-oriented stuff here and look at put-call ratios. For the broad market, the one I like to discuss is the equity-only put-call ratio. It encompasses all stock options that trade, so several million options every day, but no futures options and no index options. The theory, it's a contrary theory, is that if there's too much put buying, that means everybody's bearish and we need to be bullish. Conversely, if there's too much call buying, then everybody's bullish and we as contrarians should be bearish. So quantifying what too much is the first thing we're going to get to, and then we'll worry about interpreting it. Just for definition, the standard put-call ratio was invented by Marty Zweig back in the late 1950s when he was taking option volume out of the over-the-counter option broker-dealer ads in Barron's each Sunday. And he defined it as the ratio of puts traded to calls traded. So for example, let's say today in the modern world, we look at IBM at the end of the day and we sum up the volume on all the puts that traded that day. And then separately, we sum up the volume of all the calls that traded that day, and we divide the two. So since puts are in the numerator of the fraction, put bind generates high numbers for the ratio. And since calls are in the denominator of the fraction, call bind generates low numbers. So it tends to move the opposite direction from the stock market itself or from the underlying itself, because when the underlying is rising, that's when you get call buying, of course, and so the ratio would fall. I don't know why Marty didn't do the call put ratio instead of the put call, but he didn't, and it's pretty much stuck this way ever since. I keep a moving average of these numbers. A 21-day moving average seems to work pretty well. It gives me 6 to 8 signals per entity per year, which is, I like to treat this as a quasi intermediate term indicator. So for me, that's intermediate term. The underlying and the ratio move opposite to each other, as we were just sort of saying here. So let's take this case. These the stock is rising and it begins to fall. So as it begins to fall, people start to buy puts. They're buying puts, and they're correct during the trend. They're buying puts, and the stock is falling. Eventually, the put buying exhausts itself, and now call buying starts to come in, and the stock begins to rise. So when you're looking at a put call ratio chart, and we put up about 400 of these on our website every day, when you're looking at this kind of a chart, you should see this inverse relationship. If you don't see it, then there's hedging activity or arbitrage activity or something else going on there, and you would not want to trade off that put call ratio chart unless you see this inverse relationship. So here's just, this isn't the current chart of the SPX, but the equity only put call ratio is on the bottom there. The chart of SPX is on the top, and you can just see the inverse symmetry that is in existence most of the time. So it works pretty well. It's not, nothing's 100%, but it seems to do a pretty good job of identifying things. So peaks in the put call ratio are therefore buy signals for the market, and troughs in the put call ratio are sell signals for the market. So that's how we interpret it. So here's the current chart. This is up to date now. The S&P is on top, updated. This is updated through Friday. And the equity only put call ratio is on the bottom. So you can see, for example, last fall when the market was rallying, people were buying puts and the put call ratio was falling. And then in late November, it rolled over, and that gave us a sell signal about right in here. Now, it wasn't immediate, but then it certainly started to fall. Then in February, so as the market was falling, then people are buying puts all the way up to here, and then the put buying sort of runs its course, and the ratio rolls over to a buy signal, and that was a good buy signal for the rally that followed. We had a little bit of an intermediate thing going on there. I'm not sure what that was, but we had a sell signal in late April, and now we've reversed back here last week to a buy signal. So this ratio is on a buy signal right now for the broad stock market. But we also look at a different kind, or a similar but slightly different kind of put call ratio, and that's the weighted put call ratio. You couldn't do this without a computer, but since the since the advent of computers, this has become another popular way of looking at a put call ratio. So again, let's say it's IBM, and at the end of the day, we look at an option, any option, we look at its price, and we multiply that closing price times the volume that traded in that option that day. So now we have how many dollars were spent on that option today. So we call that the dollar volume of that option. Then we sum up those dollar volumes for all the puts, and separately we sum up the dollar volumes for all the calls and divide the two, and that's our put call ratio. So now we're measuring the dollars being spent on bearish opinion versus the dollars being spent on bullish opinion. And in my, my experience, that gives you a better measure rather than just looking at volume alone. There aren't too many places that offer this information, but there are a few around. So here's the current equity only put call chart weighted. This is a weighted ratio now. So you see the signals, first of all, a little cleaner. We don't have that little bump that was in there before. So we had a buy signal, we had a sell signal in August, buy signal in September, sell signal in December, buy signal in February, and then a sell signal in April, and we're still on that sell signal. So this ratio is not relinquished. Now, it does look like it might be getting ready to roll over, and I'm going to talk a little bit more about that later on. But so far, It has not rolled over to a sell signal. So these are our two main put call ratios that we look at. They were in sync at the February bottom, and in fact, they were both in sync in late April when they gave sell signals. But now they've divided. The standard ratio, the first one is on the buy signal, the weighted ratio is on the sell signal. So we're waiting to see. Now I mentioned that it looked like it was beginning to roll over, but we can't say for sure. This type of approach using a 21-day moving average and is amenable to computer programs that work like chess tree programs. So the computer knows what numbers are coming off the 21-day moving average, and it kind of knows what numbers are going to be coming onto the 21-day moving average because it knows what the ratios have been recently in recent days, and so it can sort of draw a tree forward of probable values. And when you start to get a slight little curl over in the chart, you might say, "Whoa, is that going to be a buy signal or not?" Well, the computer can weigh in on that and give you some help. So right now, the computer analysis is agreeing with the things that I said before, in that both these ratios are split. Standards on a buy signal, the weighted's on a sell signal. So we're watching there for some confirmation. Now there's another ratio that we pay attention to, put call ratio, and that's the total put call ratio. And this is all stock options that trade, all ETF options, all index options, but not futures options. So everything trading, let's say, for example, on the CBOE or any of the listed regular option exchanges. This rarely gives a signal, and we only pay attention to buy signals here. The sell signals have not really ever been all that significant, but the buy signals are. In fact, when it does give a buy signal, it targets a 100-point rise in SPX. So right now, the last one occurred in February, and of course we had much more than a 100-point rise since then. But now we're in an oversold state. Remember, I said before, oversold does not mean buy, but it means get ready to buy. So this will be setting up a buy signal in the near future. We just don't know exactly when. I'll show you the chart of it. And this green line right there is drawn at the 0.9. So when the 21-day moving average, again, I'm using a 21-day moving average here, of the total put call ratio reaches 0.9 or higher, the market is in an oversold state. And we wait for it to roll over like this to give us that classic buy signal where it rolls over. And when that happens, then we expect SPX to rise by 100 points. So these are the last 5 signals going back for the last 2 years. We had a 100-point rise there in late 2014 after the October bottom. We had a false attempt at one here in mid 2015, another false one in August, and then finally October 2015, a true one. These two were fairly small. The system that we use to trade these with has stop-out rules associated with it, so the losses there were fairly small. This made the 100 points, and then again, the one in February also made the 100 points and more. But this has a great track record to it, so we're watching this very carefully. We've moved up here above 0.9, and we're going to start, we are monitoring it daily, but that's part of the information that we provide to our customers. We can also apply put call ratios to individual charts. So let's take a look at a few of those. There's some interesting ones. Here's U.S. Steel, and again, same concept. A trough in the put call ratio is a sell signal for the stock. So we actually played this trade back here. This is a stock chart up here, by the way, and it's unscaled, so I don't have the actual price on there. These numbers over here refer to the put call ratio. So 500 on a weighted put call ratio, for example, means that $500 are being spent on puts for every $100 being spent on calls. Excuse me. So that's a lot for most stocks, but not necessarily for this one. Anyway, that sell signal was pretty successful, made about 4 or 5 points there, but now it's rolled back over to a buy signal. So we just are now buying this one. we put out a buy recommendation on this one late last week. Another one that's interesting here is Baidu. You can see that Baidu has a pretty good history of these buy signals. The peaks are pretty good buy points. Peaks in the put call ratio chart, pretty good buy points, and the troughs are pretty good sell points, especially when they occur at at the extremes. So now we just had another buy signal here. Just really, stock has already started to move up. This buy signal is lagging a little bit, but sometimes that happens because they are 21-day moving averages, so they can lag slightly. Here's Celgene. This guy just gave a buy signal. Um, the chart has kind of been sporadic and not doing too well, but put call ratio got up here to its highest level that it's been at in a year and then rolled over. So I figured that's at least worth a mention as a potential buy signal. Another one, same sort of thing is Starbucks. Again, it's kind of been bumping along, sort of wandering a bit aimlessly. But now the put call ratio got up here to a very high level for Starbucks. You can see it's the highest in a year, and it rolled over and gave a buy signal. So this buy signal here was not too great. It was sort of sideways up. This one over here was better, but what we'll see. So there's a buy signal there, and then finally just one more. Apple. Apple, of course, gets a lot of action and interest by everyone, and the last few signals have been pretty good. This buy signal here was decent. This sell signal here was, came about a month ago before some of their recent problems, and now we've got another buy signal again about a week ago. So, again, something that I think is significant on those 5 charts. All right, so that's the all I'm going to say on put call ratio. Let's move on to the third indicator that we look at, which is market breadth. And breadth is very simply advances minus declines, and we can do various things with it, but typically the most obvious thing you do is you keep a cumulative total, a running total of market breadth. Now, New York Stock Exchange market breadth is the one that people pay attention to the most. Well, let's say probably novices pay attention to the most, but professionals have long since realized that there's problems with the New York Stock Exchange breadth, and they've been exacerbated in the last 15 years or so. The problem is that there's a bunch of things that trade on the New York Stock Exchange that are not stocks. They're bond funds, closed-end funds, other kinds of things that are maybe more interest rate oriented than they are um, stock oriented. And it really hit home with me back in 2001. In the fall of 2001, I remember watching TV, and there was a guy in there who said, well, the New York Stock Exchange advanced decline line just made a new all-time high. I was thinking to myself, wow, because we're pretty bearish on the market. It didn't seem like it was that kind of market. But I looked and he was right. This is the New York Stock Exchange line. You can see here it's making a high, but just take my word for it. That was the all-time high. And I said, well, we've got a pretty good universe of stocks to work with. That's all stocks that trade options. What if we just looked at optionable stocks and computed an advanced decline line from those? So we did. And you can see it was going straight down, which is more in line with what I was thinking. So since then, we've started to keep 2 sets of data. One, the New York Stock Exchange data, we still keep it, just because I think it's important to know what it's saying, but you can't really rely on it. And the other, the stocks only. Now, the New York Stock Exchange does publish what they call their operating companies only data, but frankly, I find it hard to find. And again, I'm not really sure, but this seems to be a very easy way for us to do it anyway, because we've got the data on all the optionable stocks. Now, one of the things that was really causing this discrepancy was the fact that we went to decimalization back here in 2000. Prior to decimalization, if there was a preferred stock traded in the New York Stock Exchange and interest rates let's say, ticked down a little, then that preferred stock would not trade up one tick, because in those days that tick was an eighth of a point, 12.5 cents. So, that stock's not going to move that much on a small tick downwards in the bond market. However, today it might, because it might trade up a penny or two and then qualify as an advancing issue. So that was a big impetus to why this discrepancy became large. Now we keep an oscillator. The oscillator is at whatever value is at For today, we take 90% of yesterday's value and add 10% of today's advances minus declines. If you want to keep this yourself, all you need to do is get the starting value. If you shoot me an email, my email address is at the end of this presentation. I'll send you the starting point. Here's the stocks only oscillator going back a couple of years. Well, actually back to March of 2015. So it's just 12 months, 14 months. Um, the S&P is up here. This is the oscillator. So if it's above plus 200, it's in overbought territory. Now, again, remember I said overbought doesn't mean sell. So we don't actually sell here until it comes back out of overbought territory. Similarly, if it's below minus 400, it's oversold. And again, we don't come out, we don't give a buy signal until it comes out of that. So we had a buy signal here in February near the bottom. And we just had one here a week ago. We've already raced up now into overbought territory. But again, it could get way overbought. Look what happened here last February. So just because we're slightly overbought right now in this indicator doesn't mean that we can't get extremely overbought. In fact, a lot of times when a market is breaking out, that's when it gets most overbought. So if this market were to go to new highs, I would expect breadth to expand tremendously and for you to get into a very overbought state. But for right now, the last signal we had was this buy signal about a week ago, and we're now in slightly overbought territory. Um, so just summarize what I just said. Um, the I was showing you there the stocks only had reached oversold status and gave a buy signal. The New York Stock Exchange advanced decline line did not ever reach oversold status in that last sell-off. There was too much positive data coming out of the bonds and other things there, so it never gave a formal buy signal, but it is in a slightly overbought territory working off a previous signal. So it's bullish for the market, broad market, as long as they remain in these overbought states, which, looks like they will. I mean, breadth today was even positive, even though the market was down most of the day, but came out positive breadth at the close of the day. Mhm. Now I mentioned that another thing we can do with the breadth, besides keep that oscillator, is to keep cumulative breadth. So this is a running total of daily breadth, advance minus declines. We just add them up as we go forward. Um, this I use as a very long-term indicator, and so do others. But right now there seems to be a lot of controversy about this particular indicator. There's a negative divergence in breadth when the market, let's say the S&P 500, makes new all-time highs, but stocks only, cumulative breadth does not. In other words, cumulative breadth involving just our stocks only data, not that New York Stock Exchange data. Here's a chart. This is the S&P on top. This chart goes back to 2012. And here's cumulative breadth on the bottom. You can see everything. They were moving together, making new highs, new highs, new highs, all the way up to here. The SPX made a new high, breadth made a new high, and that was in uh, early, near the summer of 2015. And then things started to deteriorate. Breadth started to fall off sharply. The stock market had a few bumps in it, but the stock market keeps coming back to its highs, and breadth is not. So to me, this is a negative divergence. Back here, people definitely agreed it was a negative divergence. Now I'm hearing people say, well, it's no longer negative, but looked pretty negative to me. I mean, we were within 35 points of the all-time high right now, and breadth is way, way below. That's a lot of issues of cumulative breadth that would have to make up in order to be breaking out to new highs if SPX broke out to new highs. Now, some more advanced technicians figured out that you could look at advancing volume and declining volume. And then if you did that, you could actually use New York Stock Exchange data because the volume is in all the big stocks, not in these weird little non-operating company things that trade. So if we did New York Stock Exchange cumulative volume breadth, in other words, each day we add advancing volume minus declining volume to a running total, the chart looks like this. Here's S&P. Here's the cumulative breadth. Again, you can see S&P near its all-time highs, cumulative breadth, cumulative volume breadth, well off the highs. So Again, to me, that's a negative divergence, and I hear people saying, "Well, we use the S&P 1500 for cumulative breadth, or we use some other thing." I don't know. I'm not sure what you're using, but to me, this New York Stock Exchange, by the way, cumulative breadth has now made a new all-time high, but that's completely distorted and not usable. This sort of thing still is as a warning sign. Now, can you time off of this? No, you can't time off of this. But the point is that when this negative divergence gets into place, you should not ignore sell signals from your indicators. So, for example, last fall, when the market got almost all the way back to its all-time highs, we sold off in August, then we rallied into November, and we were almost back at our all-time highs, and breadth was way off those highs, and that was saying, all right, next sell signal will, take some negative action. If you recall, we had a modified Bollinger Band sell signal by that time, so we just bought some puts to put in our pocket and hold them until the market broke, which it eventually did in January. So right now, the only actual sell signal that we have so far is the equity only weighted put call ratio. And so we're still holding a few puts based on that, but we really don't have any other sell signals at this time. But it's still a warning. And if we get some sell signals coming up, I will definitely be taking not a huge position, but a core short position. All right, so that's the third indicator, breadth. So the fourth indicator we look at is volatility and the entire volatility complex. And there's a lot of moving parts to this, but basically VIX is the number one thing that people look at, even though I'm pretty sure they don't understand what they're looking at. But there's two things to really understand about VIX. First of all, the trend of VIX is very important. It should be opposite to the stock market direction. Secondly, spike peaks in VIX are buy signals. So, those are two things that we want to watch for at all times. This is a little less significant. A low VIX does indicate the market's overbought, but the market can stay overbought. I'm going to show you a couple of slides. You'll see how overbought the market can be in terms of VIX and still rally. So a low VIX is an overbought condition, but again, not a sell signal. So first of all, here's the current VIX chart, and you can see a couple of things. These spike peaks here, I've marked with buy signals on all of them. We have a system that we actually trade these with. And the reds signals were all very successful buy signals. The blue ones were not. But you see here, this one was stopped out, and then this one took over. Again, here, two stop outs and a successful one. Now, the last one we had there was at the February lows. This was at the August lows, and then again, just after that, on a kind of a retest, again a retest, and then the lows in November. So these are all good spike peak buy signals for VIX. Meanwhile, the trend of VIX is important. So here, when VIX was trending lower, the stock market was rallying from late August up through November. Well, what's the trend now? There isn't one. We've tried to break through 17 a few times. We haven't been able to do it. We've come down towards 13 a few times. We haven't really been able to break through that. And what we have is a trading range. VIX is in a trading range. And as long as VIX is in this sideways trading range, the market can rise. It's not a problem for the market. Even if it gets down here towards 13, which it did on Friday, today VIX was up, back up about 14. But still, people might say, well, VIX is 13. That's low. That's scary for the market. Well, is it? Consider this chart. This is a 2-year chart of VIX. And here's where we are right now, 13. Well, look how much time is spent below 13, all during those bullish times of 2014 and 2015 up to the August break. So it can go a lot lower and the market can still go higher. In fact, I marked this one area right here because I think it illustrates it. This is VIX was banging around off of 13 here, finally fell below 13 in March of 2014 and traded all the way down through June and July, staying down here below 13 the entire time, got almost down to 10. So that whole time, if you'd considered that VIX was overbought at 13 and shorted the market right there, you would have been short all through this period here. But what was the market doing? The market was doing this. S&P from that early March to late mid-July, rallied from 1860 to 1990, 130 SPX points. So that wasn't a good time to be short. Later it was okay, and then even later than that, again, okay. But just because VIX is low is not a sell signal. You have to wait for VIX to rise, for the trend to develop in order to get a sell signal from VIX. And that's a very hard concept for most people to put in practice. It's much easier for them to identify the buy signals, not the sell signals. So for me right now, VIX is trendless. So VIX being trendless, that's bullish for stocks. Also, when would it turn bearish? Well, it'd have to break out of that trading range. It's going to have to close above 17. Now, a couple of weeks ago, it probed above 17. That was the same day that S&P probed down to 2025, but it rallied off of there and went the other way. So I would need to see a close above 17 before I considered VIX getting bearish. Also, VIX is overbought here at 13, but as I said, that's not a sell signal. So, oh, you might ask, what about that buy signal in VIX that was back there? Those only last in our system for about a month. So that buy signal was a good one, but it's long since expired. Now, there's another thing that you need to look at in terms of VIX, and the products that we can trade VIX with are futures, and then VIX options, and then some of these other things like VXX and XIV. Those are all of those things are based off the VIX futures. Even the VIX options trade off the VIX futures. So there's two things that we look at here in terms of the VIX futures to see, again, what is the market saying? One is, are the futures trading at a premium to VIX? If they are trading on a premium, that's actually positive for stocks. And number two, what's the slope of the term structure? In other words, how's the near-term future line up with the next future, with the next one, with the next one? That's the term structure. So we'll take a look at both of those things. And the it's generally bullish when the futures trade at a premium and the term structure slopes upwards. Well, that's what we have most of the time. It's actually what we have right now. I'll show you examples in a minute. If the opposite occurs, though, if the futures start trading at a discount to VIX and the term structure slopes downwards, then that's bearish. And it doesn't happen too often, but when it gets underway, it can be extremely negative for the market. But right now, things are sloping upwards. So I want to spend a minute and just kill a myth that's out there. A lot of times on TV, and people who hold themselves out as option experts say this. I can't believe they do, but and then the media picks it up. And they say it too, and they're saying, okay, here we are. VIX is low. Today VIX closed around 14, and the front month VIX future is the June future. It closed at 1533 today, but I look at it, the September future. I see it's trading at 19. So that must mean that futures traders think VIX is going to be 19 in September. And wow, that's that's inside information, right? So if VIX is going to be 19 in September, then that means the market's going to probably fall if VIX is going to rise. All of that is completely false thinking. The futures at 19 in September are not predicting anything. So look, first of all, you have to understand futures prices aren't necessarily predicting a. You can see it in crude oil, gold, stock market, volatility, whatever. They're not predicting a future price. They're predicting the uncertainty of predicting a future price, and I'll show you what I mean in a minute. Let's suppose that you're a market maker, and so VIX is real low here, down around 14, and so somebody asks you to price a 1 week call. You say, well, that's no problem. I'll price it with a 14 volatility because it's a 1 week call. I mean, where's VIX going to go in a week? Fine, that's fine. Then the next guy comes in and asks you, he wants a price on a 3-year option. And you go, wow, 3 years? I don't know where volatility is going to be in 3 years. So I'm just going to guess that it's going to be 25 because that's sort of the average volatility for, S&P in the long run. And I'll add a couple of points to it just to pad my book a little bit. And I'll sell this guy volatility out here at 25. All right, fine. So a 36-month option, the months are on the bottom scale here, selling at a 25 volatility, and a 1-week option is selling at a 14 vol. So now we have two data points on the term structure. So now the next guy comes in and says, I want to buy a 1-month option. Well, okay. 1 month, I mean, we know where volatility is today. It's 14. It's probably not going to get too crazy in a month, but it might go up a little because the Fed might raise rates or something. So I'm gonna bump up volatility there for this guy just a little bit, and I'm going to sell him an option at a 16 vol instead of a 14 vol. And the next guy comes in and says, I want to buy a 2-year option. Well, again, we have this long-term problem, but 2 years is a little more certain than 3 years, so I'm going to reduce that volatility just a little bit for this guy because 2 years, it's not the same as 3 years. And then by inference, if somebody came in and wanted to buy a 7-month option and a year and a half option, we'd kind of price them in the middle. So what we have is this upward sloping term structure like this. And all it is doing is reflecting the fact that near-term volatility is cheap and and below the long-term average volatility, and all the other months fall in line in between. It isn't saying anything about 6 months from now or 8 months from now, the market makers are predicting the volatility is going to go to this level. It doesn't have anything to do with that. So this is really what the term structure is about. And in fact, there's been a great trade for hedge funds over the years, and that is that they short this volatility out here rather than figuring the market's going to go down. They figure the market's going to go nowhere. And by the time this 18-month option becomes a 1-month option, this volatility is going to drop down to this level, and the short will have made the money. And I call that the big volatility short. And we usually have a position in some form or another for that big volatility short in our newsletters. Here's the current, well, actually, this was Friday, but maybe Thursday. But this is a recent picture of the term structure. Here's VIX was trading at 1582, and here's the futures prices. And you can see they slope upwards. They go up the line like we just saw in that last chart. And here's the premium. 1757 is June premium minus 1582 at VIX. At that time, that's $1.75 premium. And you can see the premiums are pretty big. So if nothing else happens, these futures are going to drop to this price or lose all this premium along the way. So that's why shorting these is sort of these pros hedge themselves, but shorting these things has this sort of built-in edge to it. Whereas buying these volatility contracts way out here in time is not normally a very good strategy. Now, you might say, well, I don't know where the futures prices are. I'll tell you, they're on the CBOE's future website. It's cfe.cboe.com. But you can cheat. You can look at the indices. The CBOE publishes 4 volatility indices. The first one is the short-term vol index, a 9-day. That's VXST. Then there's VIX, the regular old VIX. That's a 30-day volatility estimate. By the way, if you want to trade VIX longer term, you really shouldn't. It's just a 30-day thing. Just trade 30-day time horizons and keep rolling over. Otherwise, you won't match VIX performance. VXV is a 93-day volatility index, and then there's a 184 volatility index, 184-day volatility index. None of these have products that trade on them except VIX. We did have VXST options and futures, but they've been delisted. But again, the upward slope here of the values is bullish. So the construct of these things is bullish. The futures are trading at premiums. The term structures are sloping upwards. That's bullish for stocks. So the volatility complex has been routinely bullish ever since the February lows and remains bullish. Now I'm going to throw in one other indicator you might just want to kind of file away, look for some time when it might happen. Normally VIX is below VX, that's the 30 days below the 90-day. And the CBOE indices. And that's normal and that's the way it is right now. But occasionally VIX will go above the 90-day. The 30-day crosses above the 90-day. That's meaning the market's getting very oversold. That only happens in a severe down market. So when that happens, don't jump in and buy right then. Again, oversold doesn't mean buy, but it's a warning sign to buy. And then when VIX again crosses back under VXV, that's the time to buy. So first it has to go above it, close there. Then it has to go below it and close there. And that's your buy signal. So the last one we had in this case was February 11th. I trade this as a very short-term 1 week kind of signal. But you can see here, here's the last, well, this is in 2014, 2015. These red lines indicate where we had buy signals of that ilk. And not everyone was a profit, but a lot of them were pretty good profits. You can see what you're really looking at is so like a big acceleration like that over the next 5 days. Last year and into early this year, it continued with a number of these. As I said, the last one was here on February 16th. We haven't had one since then. So the market's just been boringly bullish since the middle of February, but eventually that will end, and this will be something you might want to look for. So what's our conclusion on volatility? Well, VIX is trending sideways. That's bullish for stocks. The VIX futures are trading at a premium to VIX, and that's bullish. And the term structure of the VIX future slopes upwards. That's bullish also. The term structure of the CBOE indices slopes upwards, and that's bullish too. So what would change all this, upset this big apple cart here, would be VIX breaking out above 17. That would be your number one warning sign. And later it might change, but in reality, until VIX establishes an uptrend, you don't really have to worry about VIX giving a sell signal for stocks. So let's just summarize here, and I'll wrap up a little bit. So this is my current opinion here is that SPX is neutral. But I'm leaning, a little bit towards the positive side, but it's in the trading range. It's neutral. It has to break through that resistance. The look how ratios were split. We got a buy signal from one and a sell signal from the other. The breadth oscillators are both on buy signals. They're in a modestly overbought territory. The VIX itself is bullish. So we just saw all those things. And the term structure is bullish. So those all are in that regard. And, we've got a couple of bullish things here, breadth and volatility. Kind of a split thing going on here with the put-call ratio, and SPX is sort of neutral. So I'm really awaiting a breakout here to below 2040 or above 21, well, at least 2115, which is the April highs, but even 2135, which is the all-time highs, before I get too excited about a trend developing in the market. Now, I'm just going to give you some anecdotal evidence. Anecdotal means that I can't prove this, but I just feel this way. And you're seeing, to me, just a lot of obvious things. Like everybody knows these things. Everybody knows that VIX has had trouble. I mean, SPX has had trouble at the 2100 level in the last year and a half. So it must be a good time to short it here, right? At 2100, because it's been working out. Everybody knows VIX is too low. It's down at 13, and that's low. Everybody knows the Fed's a problem. Everybody knows the election's a problem. It's not just Trump. Everybody knows the global economy is a problem. There's just not any really good news here. So it's really easy to be short at these levels. And I'm telling you, all the big hedge fund guys on TV seem to be short. All the short-term traders seem to be short. The only bulls are the guys who are always bullish. And even some of them say, well, there could be a correction before. The problem with all of this is the market never makes it easy. And so I just have this anecdotal feeling that we might continue to break out on the upside. And, I'm probably not going to jump on it until it actually does, but that's just my gut feeling there. And then finally, one other piece of anecdotal evidence, this is a much longer term thing. But I started trading back in 1970. So I came in this bear market right here. And I didn't do too much with it. I was just kind of messing around at that time. But the market had rallied from really the end of World War II all the way through the middle of 1966 without much of a correction. Then there was a bear market. There had been this mini bear market back here, but it was a short-term one. Then a big rally took all market all the way back to its highs, and then a even bigger bear market in 1970. And this rally took the market again all the way back to a new all-time high at the beginning of 1973, and then a very nasty bear market took out the lows of both the previous two, 1974, and then finally bottomed. So when we saw the market in the 90s come up and make that huge bull market in the 90s, and then we had a bear market in 2001, 2002, we're down on this scale now. Then we rallied all the way back to new all-time highs, and then failed and broke those lows in 2008, 2009. I was surprised to see that we didn't have a third bear market. That we just went right on up like this. But as people have pointed out to me, that is still without necessarily having the exact degrees of height of this bear market. There's still a chance the third bear market emerges here. So in the longer term, I could still see that happening. But in the short term, I think the shorts might have to get shaken out of their positions here before something like that could take place. So as I said before, you can download the PowerPoint slides at this URL. That's on my website. And the PDF of this presentation is there, and as well as offers on various of our products, newsletters and video, well, not video, I guess CDs, DVDs, something like that. This is my information. If you want to shoot me an email, feel free. And if you want the starting point of that oscillator sequence, just shoot me an email there and I'll send it back to you there too. Anyways, that's all I have. So if there are any questions, it looks like we're 4 minutes. Wow, it took for a long time. 4 minutes, or if not, I don't know if Josh is still there, but he might jump back in here. All right, everyone. Well, thanks for attending and great training. Oh, here's a question. Is it too dangerous to do iron condors on stocks? I think iron condor strategy is a pretty dangerous strategy. I mean, it depends how many standard deviations you can get out, but um, you know, it's one of those strategies where you see results like 96% winners, and then the loser takes you out of 20 winners. So if you're selling deeply out of the money condors for a dime or so, and then and then eventually lose 10 points or something, or 5 points, it just makes it too dangerous. We used to run an actual program of condors, and there were just enough sharp declines in the market to keep it from being decently profitable, so I let it go. So I would say it is dangerous. Your buy sell signals look like long term. Well, as everyone's definition of long term is different, Yeah, I mean, what's long term to an option trader? I mean, our VIX signals are a month. I mean, I'll stay with a trend if I can, using a trailing stop. So, buy signals that we had back in February, I'm not really riding those anymore. That's 3 months. So, I don't know. I think of that as more intermediate term, but I guess if you want to think of it as long term, you could. What's your option recommendation service? Well, we have a couple, but our main one is called the Option Strategist newsletter. That's a weekly service. We also have several daily services. If you go to that URL, you'll see them listed there. So, what does your signal indicate near term? Well, near term, again, as I said, I'm flat because SPX is kind of in this trading range. The only near term thing that we actually did have was that breakout to the upside over that triangle and a buy signal from the breadth oscillator. But those they're pretty short term, so I'm still viewing it as kind of a near-term neutral situation until we can break out. All right, everybody. Thanks for attending, and have a great week and summer too, for that matter. Thanks for attending.